Namaste dosto. Today we unpack a recent Goldman Sachs research report on AI capital expenditure. Everyone keeps fighting over whether AI demand will justify the spending. The analysts ask the opposite question. How do we even know what the spending is? Turns out, the famous 4 to 8 trillion dollar number is not fixed. Four assumptions move it by trillions. Let's go. 4 to 8 trillion dollars. A 4 trillion dollar gap, roughly the GDP of India. Casual swing, no problem. The usual debate is whether demand will justify this. The analysts flip it. How confident are we in the spending number itself? Answer: less than we think. A few quiet assumptions move it by trillions. First, the baseline. Total estimated spend 2026 to 2031 about $7.6 trillion. Annual spend doubles from 765 billion in 2026 to 1.6 trillion by 2031. Look at the composition. Two-thirds is compute, meaning chips. 28% is data center buildings and cooling, and only 5% is power infrastructure. Remember that last number, it matters later. Assumption 1. Chip useful life, the single biggest lever. Today, accountants depreciate GPUs over 4 to 6 years, but Nvidia ships a new generation every year, each one a step change in performance per dollar. A chip you bought in year 2 may be uneconomic to run in year 3. Look at the swing. Moving the assumed life from 3 years to 7 years changes depreciation by $1.8 trillion. One assumption, one spreadsheet cell, 1.8 trillion. Assumption 2. The buildings. Gen 1 cloud data centers were 5 to 15 kilowatts per rack, air-cooled and boring. Gen 4 AI factories are over 500 kilowatts per rack, a 50 times jump in power density. Air cooling has left the chat. These are liquid-cooled, racks co-designed with chips, and cost per megawatt has roughly doubled. Swing on data centers alone, about $1.1 trillion between conservative and aggressive cost assumptions. Assumption 3. The chip mix. Most AI compute today runs on Nvidia GPUs. The big question is whether ASICs, Google's TPUs, Amazon's Trainium, Meta's chips will eat that share. But the analysts make a sharper point. The answer depends on demand elasticity. If inelastic, cheaper chips means lower total spending. If elastic, cheaper chips means more usage. Same total bill, just different margins. Today's reality looks elastic. So chip mix mostly reshapes who eats the margin pool, not how big it is. Nvidia's GPU gross margin is around 75%. That kind of cushion is what tempts everyone else to build their own silicon. Assumption 4. Elongation. 4 bottlenecks stretch the timeline: power interconnect queues, permits, specialized labor, and long lead times for transformers and switchgear. In the base case, this just stretches the schedule, doesn't shrink the total spend. But if delays get bad enough, narratives flip. Investors start asking demand questions before supply is even ready. Supply friction creates demand doubt. That feedback loop is how a stretched timeline becomes a smaller build-out. Quick recap. 4 levers move trillions: chip life, cost per megawatt, architecture, and elongation. Now, equally important, what does not move the total? Training versus inference mix? Affects when the cash comes back, not how much you spent. Memory pricing spikes? Already in the chip roadmaps. Shifts silicon margin, not the total envelope. Behind the meter power? Yes, project costs go up, but power is only 5% of the bill. These 3 dominate AI news headlines. For the trillion-dollar question, they're sideshows. And the wildcard, the thing no spreadsheet can model. January 2025, DeepSeek. Nvidia lost $600 billion of market cap in a single day. The market believed, for a week, you could train models with a fraction of the compute. It turned out not to be that paradigm shift. But the risk doesn't go away. And the paradox to end on: if we fail to deploy these trillions, the AI dream stalls. If we succeed, history says cheaper compute unlocks demand we can't yet imagine, meaning today's build-out, however massive, may not be enough for tomorrow. So friends, the number is not the number. 3 questions to ask anyone confident about AI capex. 1. What chip useful life are you assuming? 3 years? 4? 6? It moves the bill by trillions. 2. What's your cost per megawatt? Old cloud era numbers are off by half. 3. Is your model elastic or inelastic on compute demand? That decides whether alternative chips reshape the total or just the margin pool. Stay skeptical of confident numbers. Prakash signing off. Bye bye.